All right, welcome to The Explainer. Today, we are diving deep into the world of banks. We're going to break down their fundamental role in our economy, and here's the twist. We'll see why the very thing that makes them so essential is also what makes them so incredibly fragile.
So here's how we're going to tackle this. First, we'll look at a massive information problem that markets have. Then, we'll see how banks pop up as the solution. After that, we'll explore their second kind of mind-bending job as time travelers. And finally, we'll get to the heart of the matter, a deep paradox that can put the entire system at risk.
Okay, so to really get why banks even exist, we have to start with the fundamental problem they were invented to solve in the first place. I mean, this is the big question, right? We're always told markets are super efficient, so why do we need these giant intermediaries, these banks in the middle of everything? The answer gets right to the heart of what makes finance work and, what makes it fail so spectacularly sometimes.
And it all starts with this concept called adverse selection. It's a classic case of an information imbalance. Think about it. In any loan, the person asking for the money, whether it's a startup founder with a big idea or someone buying a house, they know way more about their real situation and their ability to pay it back than the person or institution lending the money.
So here's where it gets really tricky. If you're a lender and you can't tell the good risks from the bad ones, what do? Well, the only logical move is to charge a high interest rate to everybody just to cover your bases. But guess what happens? All the safe, reliable borrowers look at that high rate and say, no way, and they walk. That leaves you with only the riskiest people who are willing to pay that high price. And just like that, the entire lending market can just seize up and fall apart.
Okay, so how does the financial world fix this puzzle of trust? Well, it doesn't just hope for the best. Instead, it creates a specialist, an institution that is literally designed to handle this information gap.
Exactly. Instead of every single person who has some savings trying to become an expert credit analyst for every possible loan out there, banks centralize that whole process. They get really, really good at screening applications, they build long-term relationships with clients to truly understand their business, and they keep an eye on things even after the loan is made. Information isn't just part of their business, it is their business.
And this right here is the whole idea of delegated monitoring. It's beautiful, really. It's all about economies of scale. Thousands, even millions of us pool our money together in a bank, and we delegate the super expensive and time-consuming job of checking everybody out to this one expert entity. It saves us from a world where every investor has to vet every single borrower. I mean, can you imagine? Nothing would ever get funded.
But, solving that information problem, that's only half the story. Banks also have this other crucial and honestly way more delicate job, which is basically managing time. Just think about this for a second. It's a fundamental conflict in the economy. As a depositor, you and I, we want our cash ready to go at a moment's notice, right? We want it to be liquid. But a company building a factory or a family buying a house, they need that money locked in for years, sometimes decades. These two desires are polar opposites.
And this is where banks perform this incredible trick. Economists call it maturity transformation. What they do is take all of our short-term, I-want-it-now deposits, and they magically transform them into the long-term, stable loans that the economy absolutely needs to invest in big projects and to grow. It's like a kind of financial alchemy, and it is totally vital.
Okay, but, and this is a huge but, this really clever solution, this act of financial time travel, it creates a huge, dangerous paradox right at the very heart of what banking is.
So on one hand, this whole process is a cornerstone of any modern economy. By letting us depositors have our money whenever we want, while also funding those big long-term projects, banks are injecting essential liquidity that lets the whole system run smoothly.
But this creates a massive vulnerability. The bank's assets, all those 30-year mortgages and 10-year business loans, they are locked up. They are illiquid. But the bank's liabilities, our checking and savings accounts, are due on demand right now. This mismatch right there is the built-in fragility of every bank.
So this is the key. The very thing banks do to create liquidity for us, for the whole system, makes the bank itself incredibly illiquid. It makes them unbelievably vulnerable to a crisis of confidence. Because if enough of us get spooked and show up demanding our cash, the bank can't just sell off a skyscraper or a factory loan to pay us. And that is the seed of a bank run. And that really shows you the central trade-off of all of modern finance. Banks exist to solve these huge market failures, problems with information and with liquidity. But in the very act of solving them, they create a brand new kind of fragility.
And that fragility, oh, it does not stay in one place. The problem at a single bank can spread like a contagion through the entire economy.
So maybe it starts small. There is some stress on one bank's balance sheet. Perhaps some of their big loans start to go bad. Or heck, maybe it's just a rumor that starts spreading, triggering a loss of confidence. Well, that can quickly spiral into a full-blown funding crisis. The troubled banks start scrambling for cash, and all the other banks see this, get scared, and they stop lending to it. And maybe they just stop lending to each other too. The credit markets just freeze up as everybody gets paranoid. And because banks are basically the plumbing of the economy, they're the one pumping credit everywhere, their problems don't just stay in the world of high finance. They spill out into the real economy. Businesses suddenly can't get loans to expand. Hiring stops. And the entire economy can grind to a halt or even shrink.
This quote from our source material just nails the dilemma. The financial pipes that are so amazing at carrying capital where it needs to go in the good times, those are the very same pipes that can carry panic and contagion everywhere in the bad times.
And at the end of the day, this is the big takeaway. The financial system isn't just a bunch of separate companies. No, it's a deeply interconnected web where one bank's health is tied to everyone else's. A problem that starts at the micro level of a single firm's bad decision becomes a macro source of fragility for all of us. Which leaves us with this massive, critical question that regulators and economists are still fighting over today. We absolutely need the efficiency that banks give us, but that very same efficiency seems to create this terrifying fragility. Is it even possible to design a system that gives us all the benefits of banking without the devastating costs when it all goes wrong? That is the puzzle that sits right at the very heart of our financial world.